Ever had a member say, I already have a home mortgage, so why do I need a HELOC? Let's clear the confusion, because understanding how a home equity line of credit actually works could help your members unlock cash without starting a whole new loan. Welcome back to Jay Get It, the channel that makes banking education simple and practical. Today, we're breaking down the home equity line of credit, how it differs from a loan, how draw and repayment periods really work, and what to watch for when rates change. By the end, you'll understand how to explain HELOCs with confidence and compliance. Think of a home equity loan as a one-time check. You borrow a fixed amount and repay it in installments. A HELOC, on the other hand, acts more like a credit card secured by your home's value. You draw, you repay, and withdraw within limits. That flexibility is why members love it, but also why it requires careful education. Here are some key features. Number 1, variable interest rates. Most HELOCs use a variable rate tied to a prime rate. When rates drop, payments drop too. When they rise, well, members feel it. That's why we teach borrowers to budget for movement and understand rate caps. Number 2, draw versus repayment periods. The draw period is the access phase, often 5 to 10 years. Members can borrow up to their limit. After that comes the repayment period. No new draws, just pay back. Explaining this transition up front prevents surprises later. Number 3, credit limit and loan-to-value, LTV. The credit limit depends on home equity and the credit score. Most institutions lend up to 80 to 90% loan-to-value. A simple way to explain it, multiply the home's value by the allowed LTV, then subtract the mortgage balance. That's the available line. Variable rate makes HELOCs flexible but volatile. During economic swings, payments can jump hundreds of dollars. That's why ethical bankers set expectations early and offer budgeting tools. Transparency builds trust, and trust builds loyal members. Let's practice. If a member's home is worth $600,000 and you allow an 85% loan-to-value with a $400,000 mortgage, the available credit is $600,000 times 0.85, which equals $510,000 minus $400,000, which equals $110,000. That's their line. Simple math, powerful conversions. Every HELOC conversion should include a reminder of Regulation Z and Fair Lending Standards. Disclose rate variability fees and draw conditions clearly. It's not just policy, it's protection for both you and the member. When you help a member, use their equity responsibly. You're not just selling a product, you're building financial confidence. That's the heart of what we do at your credit unions and community banks. If this helped you understand HELOCs, hit like so YouTube shares it with other bankers. Subscribe to Jay Get It for more training on loan products, compliance, and member education. The more you know about how HELOCs work, the better you can guide members through smart borrowing. I'm Jay, and as always, the only people who get it are the people who get it.